From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Friday, the 13th, 2026. Lots of fun stuff is happening tonight at the Brumder Mansion in Milwaukee. There's comedy, magic, and burlesque. A little something for everybody. Everybody over 18, anyway. The Milwaukee Symphony Orchestra has a Simply Swinging Valentine through the weekend. And Saturday at the Marcus PAC, it's Stomp. Hey, your Milwaukee Bucks had the week off. They sure could use the rest. Let's start with our headline of the week. A woman in Shanghai causes multiple traffic accidents after she adjusted her car's rearview mirrors for better feng shui. A Swedish farmer has set a Guinness World Record. He crammed 81 matches into his nose to impress his kids. That sounds like a tough crowd. And finally, you got to love Vegas. A fire-juggling unicyclist was, juggling fire on his unicycle in the middle of the Strip. According to police, it was totally illegal, but the cops refused to give him a ticket, saying, "Let's all take a moment to appreciate this man's talents." You gotta love Vegas. On the podcast today, we have our Rothschild Adam Baley, Joel Dresang, and with a look back at the week, here's Kyle Tetting.
Well, thanks, Max. Tough week overall for the markets. NASDAQ down 2.1% to close on Friday at 22,547. The S&P down 1.4%, closing at 6836, and the Dow a little bit better, but still down 1.2. Added 49 points on Friday to close at 49,501 on the week. For the year, NASDAQ down 3%. The S&P back into negative territory, down 0.1% on the year, and the Dow still up a pretty meaningful 3%. Art, it's pretty hard not to look at some new volatility in the markets, or maybe some renewed volatility in the markets, and think, okay, what's different this time around? I was looking at some of your notes that we had been exchanging ahead of the show, and I think the thing that resonated with me most about what you had pointed out was that it doesn't really feel all that different than what we're used to seeing. And maybe a reminder to investors that this isn't all that different than environments you've seen before.
Yeah, and what we do is invest prudently for the long haul. This is 1 week in 1 year in which, quite frankly, we got off to a good start. The S&P was up about 1.5%. In January, we've given it all back, to this point, but that's neither here nor there. The Dow, which is now in focus, 50,000 or whatever it was, quite the news, I think is a boring conservative index that doesn't warrant much attention, other than, by the news media. The NASDAQ has been where all the excitement has been, for years, and the sell-off has been induced by questions, not answers, questions about what artificial intelligence is going to do to various industries. And we just saw that amplified a little over the past couple of weeks. But as you indicated, it's just we're used to this. We don't speculate as to where the market's going to be at the end of any day, week, month, or year. But my best guess would be the S&P would be ahead of the Dow by the end of the year if I had to speculate. But we don't. We allocate. And so what we've talked about for weeks is the broadening of this market rally, which is still, as far as I'm concerned, intact, and the fact that value stocks, conservative stocks, have been doing much better this year, significantly better than these growth stocks that perhaps had run a little too far, too fast. And I like to look at the foreign stuff these days. Last year was the best year for foreign investing in 16 years. That pattern seems to be continuing. So, yeah, it's just another, day in paradise, another week in paradise, as far as I'm concerned.
It really hits at a theme that we have been talking about on the show for, it feels like more than a year now. And the broadening of the market, where we've had just the Magnificent Seven for so long, had led the charge so high and become so much of a piece of either the NASDAQ or the S&P 500. And now we're seeing a broadening out of the market rally, where the Dow has picked up. Some of those sleepy dividend payers have done well. And that's a healthier sign for the market to see a broader rally. But for me, it's even broader than that. You're right, non-U.S. stocks are finally having their day in the sun. Part of that is the dollar story. The dollar has fallen considerably from where it was just a year ago. It's continued that trek so far this year. And non-U.S., along with those dividend-paying stocks, are having a great start to the year.
Joel, how long have I been telling you we were going to take the Dow out of reporting to start the show, just given its larger relevance?
How long have I known you?
So, again, 30 stocks. It's really hard to point to those 30 stocks and say that anymore, at least, they are terribly representative of our U.S. economy, the U.S. markets more broadly. I am quite pleased that we are still reporting the Dow results because it's the only index that, at least year to date, is positive. But it is reflective of a bit of a transition we have seen this year. Yeah, the international piece has certainly been part of that conversation. But also when you look at the typical view on value stocks versus growth stocks, the Dow, much more representative of the old guard, more traditional value stocks. It's a mix nowadays, but I do think it better captures some of those value names. And so it's interesting to see that we've gotten some renewed focus on maybe what was old and is now new again. And as an investor that likes to get a deal on what I buy, for a long time that deal was, well, I'm going to buy growth because it's going to grow. And it feels at least now like pricing has started to matter a little more, that value stocks are having their day in the sun, in part because you can get a better deal on what you're buying. And again, I think that's been a pretty happy place to be for investors this year. You know, it's really hard to go too far without pointing out that a lot of the news this week was simply on earnings. Joel, an inflation report, probably the biggest piece, but inflation, labor, all kinds of other pieces to talk about. What did we learn about inflation this week that might tell us a little bit more about where we're headed?
That it's tamer than we were expecting, that it was the Consumer Price Index, which is the broadest measure of inflation, was 2.4%. From January of 2025. That's closer to the Fed's long-term target of 2%. It's still not there, but it's closer than it was in mid-2022 when it was 9.1%. And people were concerned about high inflation. So the steps that the Fed has taken, the things that have happened since then of the economy settling down a little bit from all of the exaggerated manipulations after COVID are starting to pay off, and we're starting to see inflation settle down again. And again, we're not there, and it's always a moving target, but that's a little bit closer, and that feeds into the whole concern about what the Fed's doing next, whether the Fed's going to stay where they are with interest rates, whether they're going to lower interest rates some more, which would stimulate the economy, which would stimulate inflation. And so the other end of that is the Fed also has to worry about unemployment and the job situation. And we got numbers this week that showed that the labor market is healthier than we expected. It's not as robust as we thought, especially because the statisticians at the Bureau of Labor Statistics figured out, they went back and they benchmarked numbers from a year ago from throughout 2025, and we were not growing as much. We were not gaining as many jobs, adding as many jobs as we thought, but we're still adding jobs, and that's good.
Yeah, for me, the big number this week was the jobs number. U.S., at least according to the U.S. government survey, U.S. added about 130,000 jobs in the month of January. And it's a decent enough start to the year, coming on the heels of what was a pretty weak end to 2025 in the labor market, where we had some sizable job losses towards the end of the year. It's good to see some stabilization in jobs. A bit of a conflict from the ADP report that we got earlier last week, and also the Challenger report, where there's still possibly some continued weakness in the jobs numbers, but at least as we saw from the government survey, a stable enough start to the year.
Yeah, and you look at other surveys, other bits of information, which we were looking at more closely because this jobs report was stalled because of partial government shutdown. And again, there's a whole bunch of information we don't have from October, from when the government shut down then. But so you have to rely on other looks at what's going on with the labor market, and it's probably somewhere in between. In between the more pessimistic numbers that we saw from ADP, we also had a report from a group called Challenger, Gray, and Christmas, where they, for many years, have been looking at the layoff reports that companies make. And for the month of January, it was the worst January since 2009, since the Great Recession. So you look at more pessimistic numbers like that and the more optimistic numbers that came in this week, and it's probably somewhere in between.
Which investors love. The worse the news on employment, the more likely it's going to be that the Fed's going to be lowering interest rates. And so the market loves that kind of bad news because eventually it adds, more money to the game because people can borrow cheaper. It lets consumers, and as you said before, stimulates the economy. But this 2.4 number on inflation, I think trumps the employment figure, which I have to question as well. I think the job picture with these layoffs that are being announced, as you suggested, in record numbers, I think the Fed's got to be lowering rates, if not in the next meeting, soon thereafter, simply because it's going to be demanded, by the White House, which shouldn't have an impact. And that could be good for the economy. You've got more money coming in from the big, beautiful bill, in tax refunds. That could be spent. Plus, we have this kind of divergent economy in which the wealthy keep spending and the poor keep having higher prices and can't spend as much. So put it all together, and this could be a continued expansion, although tepid.
Those two things, though, the added revenue in people's pockets, spending it, and the lower interest rates and more money coming into the system, both could fuel inflation. And it's interesting because of all the consumer surveys that we see, people are concerned about two things: prices and the job market.
I am encouraged, at least from the labor report, the participation from prime-age workers, right? From those people that we most expect to fill the roles that are out there, that are generally the able-bodied 25 to 54-year-olds that are really in that place in life where their future growth potential depends on them participating in the workforce. And we're, Joel, at a pretty high number right now relative to where we've been in recent memory.
That percentage was the highest it's been since 2001. So that's pretty good. And it's not a flash in the pan. It's a trend that we've been seeing over months and years. So that's impressive. There was another good number that I saw where, bear with me. I was going to actually offset that with some other numbers. because that's what I do is I find really good numbers and then I find numbers that aren't so good. Two that I keep looking at are it's called the U6. It's the underemployment rate, and that's been below the pre-COVID level for a couple of years now. And the same with what's been formerly known as a good harbinger of hiring trends, and that's employment in the temporary help field. And that keeps going down. It actually bumped up a little in January, but it's down 23% from where it peaked.
And again, I think it's just a reminder that it isn't any one number, any one data point that tells us the story, but how those all work together and how they change over time that makes it so critical that at a minimum you are paying attention to the way the economy is evolving. Because when we look at an inflation number and say, well, 2.4 isn't 9, but it's also not the Fed's 2. And so when we look at expectations for rate movement, we saw rates come down a little bit this week, probably more reflective of a sell-off in the stock market than any real expectation of what was happening in fixed income, because the expectations for the Fed really haven't changed all that much. We haven't gotten this big indication that the Fed is going to be cutting meaningfully this year. In fact, the Fed seems pretty intent on sticking to the plan of data dependence. And if inflation remains a little sticky and the employment market, the labor market, is weaker but strong enough, well, there isn't a need to be cutting rates any more than every once in a while. And so I think that's an encouraging sign that at least for now the market still believes the Fed will retain its independence. That is a concern as we talk about the pressures that have been put on the Fed that would certainly, again, it's all about earnings and interest rates. So if we're going to now question why interest rates are where they are, it would certainly bring to mind, okay, how do we interpret that number going forward? Because the earnings number has been quite robust. How can we count on the interest rate figure? Well, as long as the Fed is dependent on the data, we've got a pretty good idea of where rates are going.
I remember that other positive point. And shame on me for forgetting it, because it's one of Adam's favorite indicators that wages are still rising faster than overall inflation. And that's right on the precipice between both the inflation part and the employment part. So yeah, wages are rising faster than inflation.
That's still my number 2 all-time favorite thing to see. Not the number 1, but it's good to see that wages and employment, it's a healthy sign where people are getting paid more than they're seeing their cost rise. And it can likely to continue to see good consumer spending going forward.
So Adam, what's number 1?
Number 1 is actually a convergence of 2 things at the same time. Rise in productivity and rise in the working age population. If you want to know how to grow an economy long term, you put those 2 things together. That's how you grow GDP.
And we do not have a rise in the working age population. We do not have an influx of workers the way we have at points in time in the past. And so it is productivity right now that's doing a lot of the heavy lifting. So amazing to me that we get some sometimes seemingly good news on productivity growth. Yeah, artificial intelligence is going to be a massive boom to the productivity part of the conversation. And yet it seems to be the piece that good news is bad news at times, as we saw, especially this week, Art, with a lot of the tech stocks being hurt by the semblance of an idea that maybe AI is going to step in and erode some of their earnings.
Yeah, but we don't know. And as I said before, it's really the questions about the impact of AI and what it's going to do going forward. And so even though we spent a lot of time talking about, productivity enhancement and artificial intelligence having a positive or negative impact, we think it's going to have a positive impact on, economic growth and productivity. But the real question that's being raised is, are these Mag 7 companies spending too much money? And I want to come back to that just for a moment. I think they believe that the money they're spending is going to result in higher profits down the road, or they shouldn't be spending them. And so also with respect to the economic numbers, the real question for our listeners is, even though we think that this is normal, this bit of volatility, if anyone's concerned, you should pick up the phone, call your advisor, and we'll put this in context. We don't really know what's going to happen again in any day, any month, in any year. But we do know that if we put balance into portfolios, bonds, cash, diversify, away from just, more aggressive stocks into more conservative stocks and foreign stocks, that over time you're going to do well, hopefully as well as you should, without having to worry as much about the declines that happen periodically. So that's just my suggestion for the day.
Art, you make a great point. As good as we are, we're not mind readers. And if there's something on your mind, if there's something bother you, let's talk. Let's sit down. Let's go through it together. At the end of the day, we try to asset allocate and invest in a way where you have enough risk to grow your assets and meet your objectives and goals in life, but not too much risk to drive you crazy. And we always try to tweak that as it's a moving target throughout life and throughout market cycles. So if there's anything on your mind, give us a call. Let's sit down. Let's go through it together.
Joel, we got a bit of data on the housing market, on retail sales, maybe less relevant to the conversation than the labor market and inflation, but still big pieces of the puzzle. What do we learn there?
Yeah, that's so the National Association of Realtors said that sales dropped 8.4% on an annual basis in January. That's the biggest downfall in 4 years. And we already have, for the last year or more, we've known that the housing market is like the lowest it's been in more than 30 years. So it's not getting any better. One of the things that was extraordinary in January was weather. And there aren't a lot of people out buying houses in snowstorms and when it's freezing out, right? But looking at the longer, broader picture, there's a real problem in supply of housing. We saw an article in the New York Times this week that quoted a number from an expert saying that our country may be 4 to 7 million houses behind where it should be to have a healthier housing market. And I looked at the numbers that the government keeps for how many houses are being built, and we're adding about 1.3 million houses a year. So that's 5, 6, 7 years before we would catch up.
Let me give us some more context to all of this. I think it brings up a good historical point on housing. We need to be building, on average, about 1.3 million new houses a year, whether it's single-family homes or apartments, condos, you name it. We got to build about 1.3 million just to keep up with population growth and household formation. We're finally now doing that. The last time we did that en masse, 2005, 6, and 7, we were actually overbuilding at that point, but we were building enough to keep up with population growth. But we were building too much, which was one of the reasons why we had the housing collapse we did in 2008. But then it collapsed to the point where we were building maybe 400,000, 500,000 new homes a year for more than a decade. It's 18 years later, and we're finally now building enough to keep up with today's population growth. So I think there's a lot of truth to that, where there is just a backlog of houses we should have been building but haven't. And at least in the number you reported, that could be 7 to 8 million. There's a lot of truth to that.
I was doing a little digging just on a topic that I've brought up on the podcast before, but the number of second homes that are out there, or not even second homes, but sometimes third, fourth homes. Going back a decade, it was something like 7 million second homes that existed in our country, 1 million of them in Florida alone. And if you look then at how that has transitioned, the number has actually started to come down. In 22, it was about 6.5 million. It continues to come down, although it's hard to get a really good estimate on that number because not everybody's telling you exactly the purpose of their home. And so it's somewhere around that gap, perhaps, that we have in what we need in terms of housing supply. But keep in mind that that's not just going to disappear overnight, that it is going to take some time for those homes to make their way into either someone else's hands or for someone to decide, maybe I don't need a second or third home anymore. I have had a number of conversations with soon-to-be retiring clients who are telling me they're not as interested in that second or third home, maybe as the clients that retired 15 or 20 years ago were. Now, maybe that's just anecdotal and maybe it's just the clients I'm talking to, but I do think it speaks to a larger trend towards, we'd rather take a month at an Airbnb, we'd rather be a little more free. If they eventually find a community they love, maybe they do want a second home there, or maybe that's where they move in retirement. But I do think some of that inventory that's currently being used as second homes may eventually become primary homes for people that are currently looking. With that, we enjoy doing the podcast for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.